Hey, what's going on, you guys? I'd like to welcome you back to my channel. And in this video, we're going to talk about Fibonacci. Now, one of the things I want you guys to understand about Fibs is actually used as only a visual aid, but it can be a very useful tool if you use it correctly. Now, I'm going to show you guys two different ways in how to use Fibonacci. I'm going to show you from a retail trader perspective, and I'm also going to show you from a smart money perspective. Now, retail traders, if you're a retail trader, you use things like support and resistance, you use price action, things like that to use for your technical analysis. From a smart money perspective, you might utilize things like order blocks, supply and demand, concepts like Wyckoff, different things like that. So I'm going to explain it and break it down in both different perspectives. Both methods work. It just depends on the type of trader you are and how you look at the market. Okay, so let's go ahead and jump into it. So as you can see, we have two different trends currently on our chart. We have a downtrend and we also have an uptrend. Now, when you're utilizing Fibonacci, you want to wait for the retracement. Okay, wait till you see a retracement within the market because it's a retracement tool. Now, I'm going to explain. Some traders utilize Fibonacci in two different ways. They'll utilize the Fibonacci retracement and they'll utilize the Fibonacci extension. To me, I don't understand why they use two different tools because you can combine them both within one tool. And I'll explain that once I put it on the chart. So going back to what we were talking about, if you're in a downtrend and you see the market starts to retrace, if you click on your Fibonacci retracement tool, which is over here, what you want to do in a downtrend, you want to take it from the swing high, the wicks. We want to make sure we're concentrating on the wicks because that's the furthest point in price at that time. So we want to take it from the swing high, click, and we want to drag it down to the swing low. Okay, so now we have these different levels on our Fibonacci retracement tool, but let's go ahead and click on it. That way we can actually see the levels and things like that. So as you can see, we have 0, we have 0.382, 0.618, 1, negative 27, negative 61.8, 23.6, 0.5, and 0.786. And I'll explain what all of this means once we get back to the charts. Also down here, I have my background I have the opacity all the way down. I also have prices and my levels are percents. Okay. All right, let's jump into it. So now you have these different levels in which price can actually retrace to. And so when we're looking at this, we have the first level, which is the 23.6. Now, most traders feel like this particular level is irrelevant, and most traders don't really look at retracements off this level. Same for me as well. I don't necessarily look for trades off that level or retracements off that level. It can happen, and when it does happen, most traders miss it because they're not looking to take entries off that level. The same holds true for 38.2 as well. A lot of traders don't look to take trades off of that level. Some traders do, most traders don't. Now, as you can see, when we get to the 50 and the 61.8, you can see that this particular area is indicated in gold or yellow because a lot of traders will classify this as the golden zone. You might hear a lot of people talk about that. Hey, price is sitting in the golden zone, so they want to look to take trades out of that area. So in this area, most people will mark up a zone. And like I said, they'll call this their golden zone because this is a very popular area in which retracements happen. Okay. Another thing I want you to see is you have this 78.6. As you notice, I have this indicated in red because this is considered as the last acceptable retracement before price starts to reverse and go in a different direction. Okay, so if price gets up here, some traders will still take it. They'll look at it as acceptable, but if it gets to this area here, most traders like, nah, I'm not gonna really fool with it. I think price is gonna reverse, and so they don't really want to mess with it. Okay, now going back to what I was saying about the Fibonacci retracement, and then some people use the extension. This area here, anything from 0 on down to this area here, is considered as the extension. I'll mark this in like a purple. Everything in this area here is considered as the retracement, okay? Because price, it bounces off the zero and it wants to retrace to one of these levels. Now the extension is actually where you will look to actually take profits. So let's erase these boxes here. So you have a negative 27, which can actually be your take profit 1. And then you have the 61.8, which can be considered as a TP2. Okay, so like I said, it didn't make sense to me to have this on two different tools when you can look at it all visually on one tool. Okay, so now when you're looking at the Fibonacci retracement, you want to look at it in 4 phases from a retail trader perspective. You want to look at the first point when you first mark the first point on the retracement, the 100%. When you're marking it from the swing high, this is considered as point A or phase A. Okay, this point here. Your swing low is considered as point B. Your retracement is considered as C. And your TP is considered as D. Okay, so when you're looking at the Fibonacci retracement tool and you place it on the chart, if your Fib has gotten to D, you can look at that as a completed Fibonacci. It's completed its cycle, it's completed its sequence. And so that's how you can actually look at it and subjectively look and say, okay, this Fib is completed. Let me possibly look to another retracement, things like that. Okay. Now, this is how you mark it on a downtrend. When you're looking at it from an uptrend perspective, when you see the market starts to retrace when you're in an uptrend, you want to take it from the swing low up to the swing high. So mark it from here, drop it on your swing high, and then these points will reverse. So for example, you have A, which will be your 100 as well. B will be your 0. Whatever the retracement might be, which will be your golden zone or something like that. Move this over here. This will be C. And then whatever your TP is, wherever it decides to go, or here, that would be considered as D. Okay? So like I said, we have A, B, C, and D. Same holds true for the downtrend as well. So that's how retail traders use the Fibonacci retracement tool. Okay? All right. So now let's look at this from a smart money perspective. Now, smart money traders, the way they use the Fibonacci retracement tool is a little different. And their levels are totally different as well. So let's just say we're in a downtrend. Price pulls back, it goes, and then once price, let's say price gave us a break of structure right here. So as you can see, we have a high, we have a low, lower high, lower low, and then we get a break of structure in this area here. At this point is when smart money traders will actually start to utilize the Fibonacci retracement tool. Now, going back to what I said, as smart money traders don't necessarily have all of those levels. So in this instance here, let's say price starts to pull back. Smart money traders will take it from the swing low, same concept, go to the swing high. However, their Fibonacci retracement tool looks like this. They only have a few levels. And what the thing that they're looking for is for price to retrace anywhere from 50% and in this golden area here, this golden zone here, this entire area. And they look at it in 2 different pricing metrics. So anything in the red, they don't concern themselves with, they don't look for any retracements off of that. because to them, this is considered as retail pricing. Okay? This area here, anything in the golden zone is considered as premium or discounted pricing. Now, why do they classify this as premium or discounted pricing? We'll get to that. So now, when price is retracing here, most smart money traders are looking for some supply or demand zone down in this area or some order block for price to come, push off this particular, tap this order block or demand zone, and then they're looking for price to shoot back to the upside. Okay, so now most smart money traders, they consider this as discounted pricing because they will take trades. It can be a trade here and a retracement can come all the way down here. Now, remember what I said about retail traders. 78.6 is their last acceptable retracement. But when you're looking at from a smart money perspective, they're looking at break of structures and they're looking for demand zones that price is going to come back to bounce off of. So it's looking at they consider this as discounted pricing because their risk to reward is greater. So if they come, let's just say for instance, if they take a trade here and their stop loss is up under this area here, they're riding price up like so. As you can see, this is a 1 to 10 risk to reward. They're only risking 10 pips when they're taking their trades. But let's switch this back to a retail trader perspective. If we're looking at it from this perspective, most retail traders, like I said, they're looking to take retracements off the golden zone, or this here will be their last acceptable zone here. If they're taking a trade like this and they're looking to put their stop loss, something like this up under this 100, so they're safe to ride it up here. You can see that the risk to reward is much less as opposed to a smart money trader and things like that. Even if they put their risk to reward here, from a smart money perspective, they still have a better risk to reward because, like I said, they're looking for supply and demand zones. And when they're utilizing their fibs, they're mainly only using it for break of structures for price to come back, hit a supply or demand zone, and then ride it to the upside or to the downside. Okay, so that's the difference when you're looking at a retail trader and you're looking at a smart money trader. Retail traders that look for using a Fibonacci retracement tool to continue that structure. If it's a downtrend or uptrend, most smart money traders, they look for break of structures, and that's when they look to how to actually utilize their fibs. Now, like I said, retail traders, they have different levels. Smart money traders, they're only looking for it to pass 50%. Anywhere in that area is fair game to them, and that's how they look to use the fibs. Hey, you guys, this is going to be part 1. In part 2, I'm going to show you guys what it looks like on a live market. Hey, I hope this was informative for you, and I'd like to thank you for watching.